All right, this is going to be recorded. One thing I say at the beginning of all these is watch this again, you guys, because it will put it into your long-term memory. If this is new to you or options are new to you, some of the nuances might slip by. So when you watch it again relatively soon after watching it the first time, it'll make it sink in really well. So if you wait too long down the road, it's going to be like learning it all again. It just has to do with the way your mind works. So watch it again so that you don't have to go back and revisit it and try and remember all of these little nuances throughout it. So if you like to take notes, the second time through would probably be the time to take notes. All right, so this is risk reversal with a bearish market assumption, and we actually used to call this on the floor the conversion. It's really popular in commodities. It's one of the major things to use in commodities, especially for, say, farmers and stuff like that are hedging crops. They really like this type of strategy. So this is where I got to really implement this a lot, and still used in stocks, but some of the things I'm going to be talking about, like some of the little key metrics, are really closer related to the commodities and things of that nature, because stocks have a tendency to have puts have more implied volatility in them due to the fact that people are hedging risk to the downside using puts. So those premiums get pumped up a little bit, where you don't really see that as much as in the commodities. But we're going to be using stocks and stuff like that for this still. It's still a good strategy for stocks. It's just, I'll talk about that in a little bit. One couple questions coming up. Ted, thank you. I appreciate it. How are you going to play the Comey testimony in the market? We can talk about that towards the end. All right, so let's get this on. Couple of things to get out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me from CNBC, Fox Business. Commented on everything from economic to geopolitical and market analysis. Started trading in college with a psychology degree, then moved to Chicago after graduating with a finance degree, and walked onto the floor of the Board of Trade, got a job as a runner, moved up into the pits, and started trading, or continued to trade, I should say, from there. When I was trading in college, I was investing, really more of an investing type situation, money I had earned, and then started like selling calls against things and doing covered call strategies. So in that time, throughout my career, basically starting in college and all the way till now, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. Got to get this disclaimer out of the way real quick. It says, any opinions, news, research, and analysis or every information contained here provided by ProTrader Strategies and associate companies are for general commentary, does not constitute investment advice or solicitation to buy or sell any of these securities strategies. At the end of the day, we can't tell you what you should do because we don't know your risk parameters. We don't know what's in your portfolio. All we can do is teach you how to swim. We're not really here to swim for you in a sense. So please remember that past performance of any trading system or methodology is not necessarily indicative of future results. One other thing, you guys can follow me on Twitter at Wolfman's blog, or the parent company ProTrader Strategies at ProTrader Strat. So I go back and forth, especially during earnings season. I'm a little bit more active in there, but I usually throw out some daily market stuff, and ProTrader Strategies is really good on their ProTrader Strat social media, so keep an eye on those too. Anyway, including the Stanley Cup, yes, except for this year. It was good when we first had a couple of them. It was fun stuff. Bearish market reversal, like I mentioned, this is also known as the conversion if you see it on the floor. And I've done one similar to this, but at the end of the day, the bearish market reversal is kind of becoming the known lexicon in the business. So I'm going to stick with that rather than doing conversion and talk about something that nobody's ever heard of, I guess, anymore. But this is very similar to a synthetic short, but this gives us a little bit more wiggle room. So anytime you get more wiggle room, though, you're giving up a little bit of risk, which also gives up a little bit of the profit and the performance. The bearish synthetic short is going to act one-to-one to what the stock is doing, and the bearish market risk reversal is going to act, give you a little bit more buffer on your break even, but it's also not going to give you dollar for dollar on the downside movement. So just keep that in mind as well. With this, we need to have a market assumption that is bearish, but it can also be neutral. So keep that in mind. It doesn't necessarily have to be really bearish. We can be slightly neutral. I think it's going to go down, but it could stay right here. We definitely don't want this to really start rallying on us. And one thing with this risk reversal, which is what I was talking about with the commodities, is it can also be a gauge for investor sentiment. That's what we used to do in the commodities. When we see the farmers coming in and doing these risk reversal, we were like, okay, the farmers think that the crop is really good, and obviously the prices are going to go down, and they want to kind of start hedging some of that. So they would start putting on these risk reversals because it was a reversal of their risk. And when the risk reversal is selling for a net debit, it's known as a positive risk reversal. That means when the calls have more premium equal distance from where the underlying is trading. So if you went 5 strikes up on the call side and 5 strikes down on the put side from where that underlying is trading, you know, it's easier to figure it out if it's trading exactly at the strike, which is almost never a possibility. Otherwise, you have to do a little bit of math. But at the end of the day, you'll get a ballpark figure when we pull up the platform. If the calls are priced over, then that means that the calls are more expensive, which is due to the higher implied volatility. So that's a bullish sentiment. Now, what we get a lot of times in the stocks is the bearish sentiment in those puts. They get pumped up, but that's usually due to people buying puts to hedge their risk on their stocks. So it's not always exactly a great correlating factor when the puts have more premium and giving the indication that there is a bearish sentiment in that underlying. It's not always necessarily true with the stocks, but it is more so. You'll see it more so in the commodities for sure. But anytime the puts are pumped up more, that's a bearish assumption. Anytime the calls for those equal distance have more premium, that's a bullish assumption. And anytime the calls have that, the calls like pumped up, that is a strong indication of a bullish assumption in that underlying. So the takeaway here is usually if the calls are worth more, you can rest assured there's a pretty strong bullish market assumption. It's not always necessarily the case with the puts in this particular instance. So that's just a little trader hack for you guys, just so you know, with the assumptions on directionality and market sentiment, if you will. So we're going to be building a bearish risk reversal. So we're going to be buying an out-of-the-money put and then selling an out-of-the-money call. So at the end of the day, what we're going to start doing is setting this up by buying this put. And I usually go at like a 25 delta put. The reason why is because, you know, that kind of gives me a little bit of wiggle room on both sides. So, and when we're building these out, you know, it'd be great if we could do it where it was equal distance away. It's probably not going to be necessarily the case. So the other side of that is we're going to try and build this for zero outlay of cash. Of course, we're going to have to put up premium, or we're going to have to put up margin, but we don't want to have to put out premium. We want to collect a credit or a small credit, if you will, to help pay for some of those commissions. If we get a small credit, that gives us a lot better break even towards the call side. As a matter of fact, it would be above where those calls are if you collect a credit for whatever credit you collect. That's how high above those short calls is where your break even is going to land. And if the market stays right where it's at, you get to keep that credit. And if it goes down like you want, then that assumption being correct will actually make you money. So in that regard, so it can go slightly higher, stay where it's at, or go lower, and you can make money. Whereas with the synthetic short, you're kind of beholden to the market. It goes up on a short, synthetic short, you're going to lose money. If it goes down, you're going to make money. This gives us a little bit more buffer. When you say that the calls are pumped up or pumped, do you mean that the calls at the money or out of the money are higher than the puts at the same strikes? Equal distance, so not at the same strikes necessarily, but equal distance away. So if the underlying is trading $80, okay, and we have an 80 strike, right? If the 85 calls and the 75 calls are trading at the same, that means it's a neutral assumption. If the 85 calls were trading at a premium, say those 85 calls are trading at $1.25 and the 75 puts are trading at $1, that would be a bullish market assumption because those calls are valued more than those puts, equal distance away from where the underlying is trading. But generally the case, and that's a strong case for a bullish market assumption. Anytime you see those calls pumped up more than the puts, equal distance away from where the underlying is trading. Now, if you see the puts trading at $1.25 on the 75 puts and the 85 calls are trading at $1, you know, that signals a bearish assumption, especially in the commodities. In the stocks, it's a little bit more of a gray area. The reason why is because the puts, a lot of people may have that underlying and are buying puts for protection to the downside. Now, you'll never hear me say go out there and buy puts to protect yourself to the downside. I think that's a waste of money because you're increasing what you paid for the underlying. If I paid, you know, $72 for this underlying, now it's trading $8 and I'm buying the 75 puts because I want to lock in some profit. Well, I just paid $72, the original cost, plus that $1 in premium for the puts. Now I paid $73 for the underlying, right? And if I do that over the course of months and months and months, I'm increasing what I paid for that underlying. That doesn't make any sense to me. So just keep that in mind. But a lot of people follow that mantra and don't really realize that they're actually hurting themselves. But, you know, that's a different soapbox for a different time. Anyway, one thing we don't really have to worry so much about when we're equal distance away is vega and gamma and theta, right? You know, with the theta decay, that's going to hurt, right? Usually when you're buying a option, but because we're selling this call option, it's going to finance that theta decay because the calls will decay at about the same rate as the, the puts. And if vega increases or decreases, those calls and puts, because they're relatively equal distance away, are going to act the same way. If the volatility goes up, premiums in both of them are going to get pumped up. So they will pretty much offset each other. More so in the synthetic short, which I'm not going over today, which I just did the webinars on. If you guys, I know a lot of you guys are returning. That is the case in there. This, it is a little bit, sometimes can get a little bit off by just a couple of pennies here and there, which isn't going to necessarily affect our overall profitability with this particular strategy. So like I mentioned, I usually go in, this is GE. I have a bearish assumption in GE, and I can show you guys the chart in a little bit. Just as of today, it's not confirmed, but as you guys watch the daily market commentaries and see what I do all day long, I usually don't wait for a confirmation. If I see a chart set up, I usually try to get in early, but that's just me. I may have a higher risk parameter than most people, and I probably do. But anyway, this is what I was talking about with GE. I usually setting this up, look for this 25 delta put. for the bearish assumption. And then it's trading around 40, let's say 43 cents, right? That's right in the middle market. I'm going to be looking to try and finance that. The closest way to finance that is to be selling the 29 calls. So now we finance that. We do it for 0. You know, of course, there's margin, but I didn't have to pay anything for this strategy. And if we go down, it's kind of exactly set up the way we want. Now our break even, because we paid 0, is 29. But you can see that the puts are pumped up more than the calls in a sense, because really it's closer to 28 for all intents and purposes. So these 26s show that it's a little bit, you know, bearish sentiment, if you will, which is generally the case. Sometimes you will, when you see the calls pumped up more, then that's a bullish assumption, is what I was talking about there. But I usually set it up with 25 calls, if you get, or the 25 deltas, and then try and finance that. I don't necessarily look at the deltas so much there. But if I'm buying these puts, that's negative 25 delta, and if I'm selling a positive delta, that's makes it negative. So you add those two deltas together, I get a total of 55 short deltas, which means every time GE goes down by $1, if it goes down by $1, I gain 55 cents on this strategy. So it's not a perfect correlation, dollar for dollar, like the synthetic short, but it still acts the same. So you want to try and set it up at least for 0 or a small credit. And I'll show you a couple examples where we can get credits. Only for the first dollar move. Yes, correct. Only for the first dollar move, John. Perfectly correct. And then, you know, I guess I can go into it. And then gamma adds into the call. So the second dollar move, these 26 puts on the downside, this gamma will add in to the delta of the 26 calls. So this would become a 37 delta strike on the second dollar move. So it's going to increase on the second dollar move by the gamma. Can you make this strategy IRA appropriate? Absolutely. And the way that I would make this IRA appropriate would be, because IRAs don't allow you to have that naked short call, I would go out and buy the first one that I could pay like a nickel for. So this one I'd probably be able to pay a nickel for. So that's usually what I do. And on the higher price ones, maybe like an IBM or something like that, you're going to be buying way out here for a nickel, which isn't necessarily going to decrease your risk. If you want to make it IRA appropriate, I buy the first one for a nickel. I would try and set this up where I still did it for 0 outlay of cash. I don't want to do it for a debit. So bring that into account. I'd need to make it nickel credit before I ended up buying this. So you might have to go down a little bit closer to do that, or just move on to the next strategy. But buy the first one you can buy for a nickel. That makes it IRA appropriate. But generally speaking, don't let it go to that limited risk. You know, have your out in mind before you enter this trade. I'll talk about that a little bit more here in a minute. But change or decrease your profits. Well, it's going to change your deltas, because then you would have to add these deltas back in. So if I bought this particular one for a nickel, I would have to buy back in 5 deltas. So then my overall strategy would be negative the 25 deltas, because I'm buying negative deltas, selling positive deltas. So that's negative plus a negative is negative 55. And then I buy these 5 deltas. That makes it negative overall 50 deltas. So it will decrease your profits in the sense that you're not going to be able to get that extra nickel for every dollar, which in hindsight is really neither here nor there, right? But it does make it IRA appropriate. And make sure you don't do it for a debit by buying that nickel I would move on to a different strategy because I don't know that I would want to go that close to where the underlying's trading. The 28s are only 20 cents away then in that regard. I'd have to be super bearish on that. Okay, so keys to success, picking the right underlying. But we want a tight bid ask. GE has a very tight bid ask. It's a $30 stock. You can look at this, they're 3 cents wide. Those are tight markets. The other thing, rule of thumb, any stock that's trading under $100, I want to see these just out of the monies trading for less than 10 cents from the bid to the ask. If it's a $300 stock, I usually just move the decimal point 3 ticks to the left. So if it was a $300 stock, it would be 30 cents, right? Or a $1,500 stock, the bid ask would be $1.50 wide because I moved it 3 ticks to the left. Is a rule of thumb for that. And picking the right strikes. Now, with this one, because the puts are usually a little bit more pumped up, I've mentioned it a couple of times already. We want to do it for a credit, small credit, or zero outlay of cash, right? And that includes in the IRA. Don't do this for a debit because the one thing that we can do when we're setting up any strategy at all, you guys, is setting ourselves up for success at implementation of the strategy. And if you set yourself up with a debit, you have to achieve that put strike in order to make some money. Basically you have to get that directionality right to get yourself out of the hole. That being said, if you do it for a credit, it gives you the more wiggle room. It allows you to set yourself up for success in the beginning. And picking the right duration, because we talked about this gamma, this theta, and the vega kind of all being offset, there's no sense in going necessarily closer to expiration. We want to be able to get further away from an expiration. So we want to go longer duration. And you can do the leaps for all that matter. But I usually kind of look somewhere between the 75 and 100 days to expiration is usually my wheelhouse because I'm not really looking to take this all the way to, that 100 days, generally speaking. I'm just trying to get my objective met where whether it's a fib line or a technical support area, off of some kind of technical setup. Those are the kinds of things I'm looking for. And as soon as I get to my objective, I'm looking to get out of this strategy. And the same goes for, which I'll talk about in a minute, is knowing your exit strategy. Picking the right environment. Because volatility is not going to really affect us, it's not really going to offset us. So the right environment for this one, I would say, would basically be try not to do this necessarily around in earnings. And since we're coming out of earnings, it's kind of a good setup after earnings because a lot of times, they'll start trending after the earnings because they came out with maybe bad earnings is what we're maybe looking for here. And or a continuation of a downward spiral in something like IBM or GE, which have been getting beat up lately. So we want an environment where there's not really earnings around us. And knowing our exit strategy before entering the trade. Now this exit depends on your risk parameters. I have a pretty high risk tolerance. I usually play the probabilities to try and take that emotion out of my trading strategy or just the overall trading that I do. As a matter of fact, when I was on the floor, one of the first things somebody told me, I was talking about how much money I had made or lost or whatever, and the guy was like, well, you're a real trader when you stop thinking about it being positive or negative P&L. It's all about probabilities and managing that probability of risk. So when you can stop thinking about this as money and how much money you're making or losing, that's when you kind of know you've made it over that hump because you start becoming more mechanical. It's a lot easier to be mechanical if you aren't emotional. And the money aspect or the money thought aspect of trading, you guys, is what makes you break away from your mechanics. You know, if you have an out, write it down. If you think, okay, if it gets to this level, that's where I'm pulling the trigger. I'm not risking anymore. I'm just looking at it as the probabilities. Beat me on this one. You know, go back out there and try it again, because the probabilities are the probabilities. And just because you may have lost like 2 in a row, the probabilities beat you on 2. That just means that the probabilities are in your favor now, right? So continue on with it and continue to stick with, okay, the probabilities are the process. And that will help you out. But one thing with this, pick your in or pick your out on a losing aspect of it, and pick your out where you are going to get out. I don't know how many times I've seen it done before where somebody says, I'm going to get out here, and then it gets there. And they're like, well, it's going to come back. I'm going to let it go just maybe a day or 2 more, and then it goes against them a little bit more, and they haven't gotten out. And it goes a little bit more, and they still haven't gotten out. Now you're kind of getting what we used to call, you married the trade. It means that even though you didn't like what was going on, you married into it, and now you're in it for the long haul, and that's not a real good way to trade. Stick with it, write it down, because when you write it down, you have a tendency to stick to it. And if you just have some kind of arbitrary number in your head, you can let your head play games with you. So write those things down, your exit strategy before entering the trade, put it down on paper, and you'll have a higher probability of sticking to it. All right, so the max profit on this is when the underlying goes to 0. No, I'm not going to ride any strategy to 0 because that's highly unlikely. I'm going to know my in or know my exit on the winner side or the loser side and stick with that. So, but the risk profile says max profit is to 0, just as the max loss is infinite, and keep that in your mind, that the max loss can continue to go against you. Now, is it going to be the next, you know, is GE going to be the next Google? I don't think so, but that would sure feel like infinite if it went from $30 to $1,000, or very close to $1,000. All right, so now our break evens. When we're receiving a credit, it's going to be that call strike plus the credit. And when we're paying a debit, that's the big difference. It's our put strike minus the debit paid. So if you're paying a debit, it's got to go all the way down there to where that put is, in a sense, at expiration in order to achieve that profitability. Whereas if you have a credit, you know, you get to keep the credit, but your break even on the upside is that call strike price plus the credit received. Unless it's an IRA. Well, yes, unless it's an IRA. And then, well, it's still going to be the total credit if it was an IRA, because, you know, we're going to at least do it for 0 outlay of cash, so it'd be the call strike price. And if you're saying the max loss would be infinite in an IRA possibly, then yes, the infinite loss would not be. But hopefully you wouldn't even let this go to even where your defined risk was on this. I want you guys to be getting out well before that and have that out in mind before you get into that kind of situation. Trevor, what's your percent of profit? With this one, it's not going to be a percent of profit, I think, is what you're talking about. When I usually talk about, you know, I'm going to take 50% of my max profit potential on a particular trade. With this one, I'm going to be looking at like the charts and trying to figure out where I'm going to get out. So let me throw up this Analyze tab. This is GE with it ended up being a 4-cent credit on this, it looks like. But this is your risk profile. So you can see when you do it for a 4-cent credit, the break even here is, you know, going to be at $29.05 or 4 cents, whatever my credit is there. So I get to keep that credit if it stays below that 29, and then you start getting down there below that 26 put. That's where you start making your money. This purple line would indicate what the stock would do on the, on the synthetic short version of it, or just short stock. So you can see once they get outside a particular area, they actually start acting pretty much the same, but it's going to take a little bit longer for that to happen. But if we watch this and we start cranking this down, 0, it goes, 0, our break even is right there on the number. I don't know why it moves in, but you can see as soon as we start hitting the debit side, our break even starts moving down that line, and we got to make up for it. So that's where I'm talking about. You got to make up all of that distance from where we are now to start getting into profitability. Does that make sense for everybody? All right. So this is usually in the part of the webinar where I throw it out to you. You guys have some stocks that you guys have been thinking of. I've kind of gone through and vetted a few. I looked at some of Primo's charts and found a couple of good ones. But and I've found a couple on mine. So if we can look at let's just even look at that GE. I don't think I would be selling short Boeing right now. They just blasted off today. But GE, this is what I was looking at with GE. It's in a pretty good downward turn, and this starting to look like, even though this type of doji isn't the best type of doji inside of a down move, it kind of looks like it's kind of taking a dead cap out. So that's why it was one of the reasons why I was looking at GE for this. But if you guys want to throw out some stocks, we'll go through all these steps. And I think it'll help you guys out a little bit more if you guys are participating in some of these stocks. So we've got Tesla. So Tesla kind of looks like it may have topped out. If you guys watch mine, I'm not a huge fan of Tesla, although I got some I just got out of my long position in Tesla, just from a technical standpoint. But so I'm going to look at the puts, try and find that first. One thing I was talking about, so $300 stock, 34 cents wide. It's a little bit wider than that right now, but Tesla has a lot of volume and open interest. Maybe not so much out here in the far outs, but they do have, as you can see, all of these strikes have had participation in it. Pretty decent implied vol, or pretty decent open interest. But the bid ask on Tesla is usually a little bit tighter, and there are always people in Tesla playing around you guys. So we used to say that they're in the weeds, and that means that they're just not showing their hands. They're just not giving up much edge. But if you start, if you were to offer like 2110s in the calls here, you'd have a pretty decent chance of seeing this bid start bidding up towards you as people try to better the market for you. So, but because it's a little bit wider, let's move on to some of the other ones. Some people were saying Goldman Sachs. Goldman Sachs is a $200 stock, so 21 cents wide. You can see the 30, 20 cents. I mean, I will trade Goldman Sachs because it has a tendency to have good markets as well. As you can see here, 21 cents, especially the close, when we're way out there in the out months, you're going to expect to see it a little bit wider, but you can see, 15 cents wide on a $200 stock. That's inside of that, that buffer zone that I talked about. So that's, that would work. So the next thing I would look at is going to the deltas, find the 25 delta. I would usually kind of default to closer to the market. It's trading 21.13, so we're going to be buying these puts. So the $3.75-ish that we're going to need to pay for, so that's going to have to be the 4 here. So we're going to sell those. As you can tell, it's pretty close. So 12, we're about 7. So we're 7 to the upside here, and we are, 13, or sorry, 7, 8 to the downside. So slightly bearish assumption, I guess you could say, and even though we're getting that credit, it's not equal distance necessarily. And then that's where you're going to have to add in the deltas and stuff like that and do the math to figure out the exact ratio there. But there we're getting that slight credit for it. So we can look at this on the Analyze tab, because this one I would actually probably go further out in time with this. So you could probably pick very similar strikes though and get the same thing. 29s, so the $200 stocks, $200 for Tesla. Where do we think Tesla is going to go to though? If we're bearish on it, I'd want to look at some support resistance areas, and it looks like it's at support here, but it gets much below this area here, it's going to want a free fall for a little while. So I'd take a shot on this maybe. So let's go to the trade for the 100 days out. Let's delete this one and look for that 25 delta. I'm going to usually opt to roll it closer. So we got to at least pay for $5 of this. That's going to be this one here. So we're going to end up being short 63 deltas. So, you know, a little bit better than 50 deltas. You could go a little bit further, but I like to go a little bit tighter. You could go to the, you know, the 23s and probably the, or the 23 delta and the 27 delta that gets you your 50 delta. And if you were in an IRA, I would want to roll it out here. Maybe add 5 more strikes to get to that nickel. It doesn't give me it. Let's go 50. 50. Why isn't it giving me those strikes? But anyway, so I guess, you know, for purposes of just explanation, I guess, for lack of a better word, adding that 7-cent delta in there, or 7-cent strike, which is a 0 delta, that's not going to offset any of our downward for this. But look, I mean, this is what I'm talking about. When you have to go out there and buy that call and it's so far away, don't allow yourself to go to 325 in $100 higher before you get out. Okay, don't do that. As a matter of fact, my out here would probably be if it gets above, you know, I'd look at this as a support resistance. This was acted as support before. Now it's going to act as resistance somewhere right here around 230. So somewhere around 230 to the upside is where I'm going to be looking to get out. So yeah, we'll be losing a little bit money on the 225s. I'll be losing about $5 on this, but that is going to be where I would get out, and I would write it down and not let myself go any further against that. And then on the downside, so I'd be risking $5 to the upside, and then, you know, I would probably be looking to get out at around that 200, because I think that's going to act as a psychological level. If you do more than one of these, then maybe get out of half of them as soon as you go down and touch 200, and let the other ones ride for a little while. One other thing with this strategy, the way to figure out your probabilities, when I'm talking about probabilities of success and things of that nature, you guys, is the probability of Amazon, or sorry, Amazon's the next one I'm going to be looking at, CS, is the probability of Tesla going down and testing this $200 area is about a 60% probability. 60% chance of it going down and testing it. So probabilities of getting tested are 2 times the delta, and that's another floor trader hack. Double the delta is your probability of being tested on something, and 29 is also telling you there's a 29% chance of this 200 strike being in the money at expiration by 1 penny. Delta tells you guys so many different things. It's a really great probability instrument. So we got a 60% chance of being right with this, which is better than you know, 50-50 on the synthetic short, but we're not making money dollar for dollar while we go down there either. So your probabilities decrease a little bit there. So does that make sense for everybody? kind of ran over that pretty fast, I feel. So I would be looking to get out of, if I did it as a 2-lot, maybe get out of half of them at the 200 level and let the other one ride, and I would definitely be pulling the ripcord at 230 on this one. So we can look at this as, since I set it up funny, it's going to, wait, so that's the buy of the, my call, I want the calls to be a sell. Selling the calls, buying the puts. Let's get it to a 1-lot so I can set it up as a, show you on the Analyze tab what it looks like. So let's analyze this, and it's not going to show me my limited risk on this unless I squeeze it really tight, I bet. I don't know why it doesn't flatten out on my risk side for the going above there. Oh, because I made that a short call and a short put. Oh, that's what I did wrong. Sorry, guys. There we go. So you can see that my risk is no longer any higher than that level. Yes, I'm doing Goldman Sachs right now because somebody else asked about Goldman Sachs. I just moved on. Except Amazon looks bullish to me. Amazon, I mean, there's 3 stocks I usually don't like to short ever, and that's Apple, Google, and Amazon. The 2 I usually stay away from. Or I named 3 and said 2. Those are the 3 I usually stay away from. And I love this. I love to short Tesla, but I get beat up in there too. Just that stock doesn't make sense to me. But anyway, so the other one was Amazon. CS. He's got deep pockets. He wants to short Amazon going to the moon. So just for sake of example, right, we'll look at Amazon. LOL, I wish. Can you show the risk graph? I'll show the, you mean the Analyze tab that I just did? I'll do that on this one. So let's look at the 25 delta. So we got a long way to go, CS, before we start looking really good with this one. So we're going to buy the Amazon. So our rule of thumb is $1 wide, right? We move it 3 ticks to the left, $1 wide. We've got $1 wide markets inside of $1 wide, which is good. So now I've got to at least pay for like $20 of this. So I got to try and find something where I can collect at least the $20, which is going to be these strikes right here. To set that up appropriately. Give me a second here. Let me get this right. So we're getting a nice fat credit on this one, which is nice, you know, and we have a lot of buffer in the next several days, you know, as long as it doesn't go up to 1070, we would be good. We'd get at least keep that $2.37. So that's what I'm talking about with the synthetic short. We're going to be going right here, and every dollar for dollar we're going to lose here. Now we're going to be getting 60, almost 60 cents, 57 cents on the downside for every dollar move, which is nice. You know, it's nice because look, we got a lot of room to be wrong here. I mean, the market can be bouncing around here all month long, and we'll be able to watch this credit decrease and keep that credit. And if we're right and it has a pullback, then, you know, we'll start increasing our profitability. And it's got a, you know, probability say it's got a 52% chance of coming down there to this area. So, you know, it's a 50-50 chance, but if it's 50-50 that it's going to go up also. So those are the probabilities. It's kind of a coin toss. It really comes down to your assumption. Is this a theta or a gamma trade? This is not either, because this is a directionality trade. Because as you can see here, if we look at gamma is not going to affect these out. Why is gamma 0 on these? But if we look at the theta, you can see the theta is pretty close to each other, which means they're going to offset. It's going to be off by 2 pennies, right? And then the Vega should be pretty close also on those. But everybody, I bet you if we look at this, so 106, so the 105 put, so if we look at this, I bet this has one of the has the bullish market assumption on this, and we'll be able to figure it out because it's pretty close. 106 is pretty close to 105. So let's just do this for simplicity reasons. Just go 2 ticks out of the money. So the 115s, or sorry, the 1015s are trading mid-market would be, let's say, $42 and like 30 cents or something like that. So if we go from the 105s and $15 down, that gives us the 90s, right? So you can see that equal distance away, these calls are worth a lot more than the puts. I mean, these puts that are $10 away are worth the same ones that are $1.40 away in the calls, or sorry, in the puts. The puts being $1 away are worth the same amount as the ones that are $10 away here, or $9 if you want to really beat me up on $1 there. But see, that means this is very bullish because the calls equal distance away from where the underlying are pumped up more than the puts. So this has a very bullish market assumption built into the option premium. If it is direction should be a delta play. If it's direction, yeah, it is actually. Great point, Leon. We're short 60 delta, so it's definitely, it's a directional play, a delta short play, which is, you know, negative deltas is bearish. Absolutely, Leon. Good point. So it's not a theta or a gamma trade. It is a total full-on delta. Right? And so I think there was one other one. Somebody else asked for another one? Oh, IBM was the one that I'll go over IBM real quick because that was the one that I vetted. I think it looks pretty bearish. We basically have kind of traded off here, and one could even say that this is starting to look like a bearish flag. We also just got the crossover from the 50 to of the 200, which is another, has a tendency to exacerbate to the downside when we start seeing those cross. Really solidifies the bearish market assumption. Even if we didn't see all of this fallout, you know, this was their earnings. Even though they beat earnings, I can go into on my soapbox about that. But this was where the Buffett came out and said, "I've been selling mine at 182, or I sold most of mine at 182, and then we got the big gap the next day down." So that being said, it could continue to go on further as it's crossing over. It looks pretty bearish with today's market action. So, anyway, so I kind of want to short IBM, even though I usually like on a 10% correction and something look to buy something. This one seems like it's pretty bearish. So I don't have a 25 delta in these 70 ones. I see if I can find a 25 delta out here. I probably can't. 40s. So I'm going to be probably looking at somewhere between the 30s and the 30 delta and the 18 delta. So let's just start out with the 18 delta and see what we can get building this out. So I'm going to buy these and then kind of look to pay for that. So I need to sell the 160s. So the 140s, control, sell the 160s, getting an 8-cent credit on those. So if it continues down, I get to keep that credit, and I get to keep the credit if it stays below 160. So, if it wants to come up and cover this gap, 160 is going to be where it wants to kind of settle down. So that's why I like that strike in there, because if it does have a tendency to rise, cover that gap, it's going to want to stop right here, because that's where the most time and volume's been spent. So anybody that's gotten long here is losing money right now, and they're going to be happy to have it right here. And anybody who's short there, when it comes back, is going to be just happy also. Any time people aren't losing money, they're happy, right? Or where they bought it, they have a tendency to be happy, and it has a tendency to settle down there. Or we could start seeing a little bit more panic start to happen if we get much below this. So I'm going to look for that for the downside. It gives me room to the 60. Those kind of, all those things set up for me. If it gets much above that 60, I'm probably going to cover it because I think it's going to want to try and cover that gap. So I'm going to have a pretty tight stop on this. Anything above 62, I'm out, or 63 actually. Anything above 63, I'd write it down. I'm out. I'd probably maybe even, yeah, I'd probably say 63. And then to the downside, I'm going to be looking for it to come down and possibly test this 52-week low, 42.5. That makes sense? So those are my 2 points that I'm looking for this trade. We could even, if you like fib, you could even throw up a fib if I got one. I don't have it out. Let's see, drawings, tools, Fibonacci. I think this is the Fibonacci. They changed their things around a little bit. Yeah, so fib, and I'm just going to do it down and dirty. I know that's not exact. So it's bouncing right on this fib level, but I think it's going to break and go down there and test those 42.5. So I'm going to be looking to implement this in the daily market commentary on Monday. So you guys are watching that, keep an eye out for that. I'm going to be looking to do that. So on this trade, we did this for a 9-cent credit. Let's look at this on the Analyze tab, and then there's your risk parameter. So I can try and squeeze this in to make it a little bit more. Why aren't you sliding for me, baby? There we go. So you can see we got a 9-cent credit. If it goes down 9 cents below, so if it's trading at 139.91, we have met our break even. But anything, basically above where we are on that short put, or on that long put, or sorry, on that short call, anything below that short call, we are at profitability. So one other one, so if the calls are priced higher than the puts, equal distance away from where the underlying is traded, and if that is bullish assumption, yes. So why buy the puts? Well, because we're looking at a bearish assumption here. And I guess I don't, people have a tendency to buy, like if you're long Amazon, people will have a tendency to buy puts just to protect themselves to the downside. Right now, everybody's bullish Amazon, so everybody's buying just calls, and it's pumping those up. So that's a very bullish market assumption. All right, so we'll do one more. Leon's got one for me, Halliburton, and it won't, all right, you type it in. Halliburton. So let's look at this one. As you can see, I have on a synthetic in here, synthetic short, because I'm bearish Halliburton. So clearly I like your trade, but I did that for the synthetic short webinar. So let's look at the same thing here. So 19 delta, I might even go a little tighter here. So the 20s, so 40 strike. I'm going to want to buy that one and then look to pay for that by selling this call here. So we could look at that as an Halliburton meets the rule. It's inside of 10 cents bid ask, even way out here, 140 odd days out. We could even look at it from the 70 days out. It's probably going to be one of the similar situations where I'm going to look to do the might have to, I hate doing half strikes, 42.5s, and the to pay for that I'm going to have to go to the 47.5s to get it in a little tighter for that, 15 cents. I might actually just go out here to do this one. I like this one better because I get the so it'd kind of be a pick 'em. I don't know. It'd be up to you. I don't like getting that close to on the short calls, so that's why I would pick this one and give myself a little room to the downside. I still get to keep the 10 cents, which isn't anything. It's going to be a scratch at the end of the day after commissions and everything probably, or at least close. But if I wanted to make it IRA appropriate, I would just do that one. That's the first one for a nickel. And again, I would not let this go to 65 in order to limit my risk. On Halliburton, I would be looking at, if it gets above this 48-ish area, definitely above, you know, 50, above 49, something like that. That's the 200-day. That should act as a pretty good resistance. If it doesn't, then I'd definitely be out of this. Looking for a target of like 41. Come and test this value area low, or the 52-week low, something like that. Can you do this for weekly options? Absolutely, Leon, you can. I would probably lean more towards the synthetic shorts on the weeklies or something like that, but you can definitely do this in the weeklies. I usually trade these further out because, you know, the way we set this up, you know, we're buying ourselves the time, so why not take advantage of it, right? But you could do it for weekly options for sure. The minimum option I choose for this one is 70 days. I don't like to go 45 days because at the end of the day, at the end of the day, the closer you are, you know, you don't have as much time to be right. So I'd much rather go a little further out and give my opportunity the time to be right. What is the synthetic short? Synthetic short, I did a webinar on it, but basically you're going to be doing the at the monies. I don't have time to go through all of those rules, but I've done a couple of webinars on synthetic shorts and synthetic longs, and rather than buying stock even, poor man's covered calls, stuff like that, just using options instead of using the underlying. And you don't have to do the borrowing costs and all that stuff. I go through all the benefits of doing synthetic shorts. So check it out. As a matter of fact, Leon, we got an offer for you. It is the $7 special, which we've done a couple of times here, but it is in the chat window. We've been like going back and forth, you guys, on the questions box. It's in the chat window. It's the $7 deal. Basically, you get all my daily market commentaries every single day. I do somewhere between like a 5 and of course I talk way too much and go sometimes 15 minutes, but I'm talking about, you know, markets. I'm talking about the economic numbers and going through those. So if you aren't very economic savvy, I go through all of those, like the PMIs, the ISM, the unemployment number we had today. And I go through all of that and explain what those individual data points mean to the economy. And then I also go into the charts and I talk about support and resistance and directionality. And then I go into my trade. So like if you guys learned anything at all from even just this webinar, I mean, you have to be trading with this. You have to, I mean, take advantage of this for $7. I mean, you can't go to happy hour for $7. And you get all of this stuff. So if you've learned anything at all, even just like what Delta teaches you, it's worth the $7 for sure. And I do all those daily market commentaries, and then I talk about every single one of my trades. I talk about the good and the bad. Like when you watch Twitter and stuff like that, everybody just talks about their winners. Nobody talks about their losers. I talk about my losers probably 75% of the time. Why? Because those are the ones we have to stay mechanical with and turn back to profitability. And I show you how to do that. Just because you've lost on the probabilities doesn't mean you can't, you know, increase duration and increase credits in order to increase your chances of profitability, and I do that all day long. I mean, if you guys have been watching my Disney long trade, I've been playing with that, lowering cost basis on that trade that's been kind of losing money, and you know, today it's done very well for me. So, you know, I'm just keeping the dream alive, and I show you how to do that in order to turn those around. So, you know, I'm not like everybody else where I just talk about, oh, yeah, you should have done this because it's a winner. No, I talk about this is what I'm going to do, and if it's a winner, this is where I get out, and if it's a loser, then I talk about that all day long so I can show you guys how I'm staying step by step with my rules. And then You also get the video courses where the options trading workshop archives. Then you also get priority access to the online options trading workshops. And like, you know, we've been filling up the go-to webinars, but you get priority access to that and these workshops where it's live and interactive with you guys. You get all of these things for $7 basically for the month. And then you also get access to me. That's one major thing. You know, a lot of you guys take advantage of it. I know I've seen a lot of you guys reach out to me. It's great. I love getting the feedback for one, but two, if you guys have an issue or a trade that's gone against you, reach out to me immediately. I can tell you what I would do. I can't necessarily tell you what you should do, but I can tell you what my rules are around that strategy and how to be or how I would be mechanical and things of that nature, and follow those rules to hopefully I can take some of your emotion out of the trade in order to make you a little bit more secure with that position. Also, you can reach out to us at trading@protraderstrategies.com, especially if you have any ideas for future webinars. And you can reach us at 310-598-6677. But take advantage of that, you guys. It's one of the last times. If you guys want to trade like a floor trader, which floor traders, as far as I'm concerned, it's still the best traders out there, because that was such a brain trust down there. You know, we'd all talk about these like little nuances of delta and stuff like that when we were bored, and come up with these different kinds of probabilities and things of that nature. So these courses are all designed to produce consistent winners using all of these techniques. I've come up with all the rules to increase your probabilities of success. So you should take advantage of it. And make sure you watch those a couple of times, because that'll make it sink in. And I bet you I've already saved you the $7 and something that you've learned already today. So if you haven't taken advantage of this yet, you should really jump on to that. All right? Does that make sense? Everybody jump on that? So are you expecting the stocks to continue to fall or reverse? Trevor is asking. I'm expecting them to continue for at least a little bit. I'm actually long deltas in my portfolio. I've been short deltas fighting this for a long time. But I kind of started slowly rolling out of that. And, you know, even today with the, lackluster data that we've had even this week with the ISM and everything else, I'm slightly bullish, because I don't know if the Fed's going to go this month. It's only about a 60% probability of them going right now. So I'd like to hear you talk. Thank you. Wolfman, here's an idea for future webinar. You show us how to trade options and use weekly options along with TA and strategies. I can do that. I could start looking at that. At which option strike the call and put parity relation works. It doesn't really matter necessarily. I just use those strikes that are equal distance away to kind of figure out that whole relationship. So it should continue. If it is a bullish assumption, it should continue even the further away you go. I suppose when you get super far out of the money, that's going to start dwindling a little bit more, but for the most part, it should work out. All right, that's all I got for you guys today. Other than thank you guys very much, and like I mentioned, reach out to us at ProTrader Strategy. If you're watching this on tape delay, you can just pause and click on this link right here, or if you're watching it on replay, and decide. And future webinars, going to be drilling down on other strategies, when and where I find them appropriate. Here's the link to the course. If you have any questions, contact us at 310-598-6677 or email us at trading@protraderstrategies.com. And like I mentioned, if you are a part of the premium membership, you have unlimited access to me, and anytime you want to reach out. I have no inbox policy, so in my email, if somebody reaches out, I'm getting back to you almost immediately, if not sooner, or as soon as humanly possible for the most part. So if you guys like to increase your probabilities of success, you know, you can either flip a coin buying stocks or try to read the tea leaves or play the probabilities. And tell you what, probabilities in your favor is what makes Vegas Vegas. They've got the probabilities in their favor, and look what they do with the extra money. So play the probabilities. Have a great weekend, you guys. Take care. Thanks.